Welcome back to another episode of the IRA Cafe podcast. I'm Jasmine Trocchia. I'm head of the marketing department at American IRA. And today I am joined by the dynamic father and son duo of Rob and Clay Stanley. Hi, guys. Welcome. I'm super excited to chat with you today.
Hi, Jasmine.
Absolutely.
Thank you for having
having
us
us
on today.
Yeah, fantastic. So we'll go. But I definitely want to have a chance to talk to both of you, like, collectively. But will you introduce yourself? Tell us who you are and what you do. Rob, do you want to go first?
Sure, I'll kick that off. I'm Rob Stanley, managing partner here at Shining Rock Equity. Been in real estate for 27 years and am thrilled to be able to work with my son on Shining Rock. We formed this company in late 22. And the interesting thing is, even though with that history of real estate, investing in multifamily is somewhat new to me. So Clay and I are able to work together and learn this business together and grow it together, which is super exciting for me.
That is exciting. And Clay, introduce yourself. Who are you and what do you do?
Sure. So I'm Clay Stanley, and I'm a partner here at Shining Rock. Just to give a little bit more background on myself, I have been doing, since I started my career, I've been doing acquisitions in real estate for a couple of different private equity funds, working for a firm out of Charlotte. And for the first couple years of my career, I was doing acquisitions in the single family world. And then now I do land acquisition for residential development for that same firm out of Charlotte. And on both of those sort of verticals, I'm very much in the financial analysis side of things. And so that's a big part of what I bring to Shining Rock Equity. So when my dad and I and another partner of ours, Kim Solomon, started Shining Rock Equity mid-22, that's really what I brought to the table, especially initially before I was able to connect with investors and all that good stuff. But that's really what I bring to the table. And I dive into the Excel spreadsheets and sort of a nerd out on that stuff so that Kim and Rob don't have to. But I very much enjoy that aspect and that side of things. And so that's what I do at Shining Rock Equity.
Am I thinking correctly? Is Kim also related, a family member?
She is my sister-in-law. I'm married to her twin sister.
Oh.
So this truly is a family business.
Oh my goodness. So, okay, Clay, I'm going to ask you an uncomfortable question. What is it like working with your dad? And does that relationship ever sort of get in the way, business, personal, or are you pretty good at like compartmentalizing that?
I would say that's one thing that we definitely discussed on the onset, like, how is this going to work? And I think we've both been, hopefully I'm not speaking for my dad here, but I think we've both been really pleased with how well we work together. I mean, generally speaking, on 90% of items, we just actually happen to agree on most items. And then the 10% of things where we might not agree on a certain avenue or certain aspect of the business, we have a really good conversation about how to move forward. And it's never contentious or anything like that. So I would say we work really well. I hope you agree, Dad.
Yeah, absolutely. I mean, I think it comes from a place of trust and shared vision and values. So we're so similar in that regard that we do agree on 95% of everything we had come across.
So does business not come to like the Thanksgiving dinner table? Do you manage to sort of keep it out of that? Yeah.
Oh, yeah.
We talk real estate.
It comes wherever we go.
Yeah. But we still go fishing together, and we don't talk real estate the entire time.
Okay.
Right.
Yeah.
Oh, riveting. Those spreadsheets, man, I'll tell you.
That's right. Yeah.
That's fantastic.
Well, that's the cool thing about real estate is there's always something new to talk about, whether it's market dynamics or a particular deal that we're working on. There's always something new. And so it keeps it exciting. And then, my dad's been in real estate for 30 years and I've spent my entire career in real estate. And then our other partner, Kim Solomon, has been in real estate for 20 plus years.
Absolutely.
And so with all the stuff that we come across collectively, it keeps it exciting. There's endless things to talk about at the Thanksgiving table.
Hmm. Riveting conversations. So, let's ask a couple of the questions I like to ask pretty much all of my podcast guests. So it's a little like semi small segment that I like to call past, present, and future. So what is one piece of advice that you would tell your younger self? Maybe yourself that just graduated high school or is just entering the workforce. What would you tell your younger self?
I'll start with that one. And actually, I've told Clay this before. He has gotten such an early start in real estate and investing in general and education along those lines, real life education. I unfortunately did not start that early. And if I had it if I could give my 18-year-old self some advice, it would be to follow what the line that Clay has and to get busy early on. So it just thrills me no end to see him doing that, actually.
That's fantastic. All right, Clay, that wasn't too many years ago for you, but what would you tell your younger self?
So what immediately came to my mind is when you get into real estate, all you want to do is deals, and you want to get into a deal as fast as possible. And so I would tell my younger self that the next best deal is always right around the corner. And so by skipping out on a deal, you're not going to miss a once in a lifetime opportunity or a generational opportunity, generally speaking. And so don't rush into things. Take your time and move slowly and be able to make decisions effectively, but with all the information that we can possibly have.
That's awesome. I love that. So in the present, twofold question, just because I want to talk a little bit more about your business. So what does your ideal client look like? And then the second part of that is, what are your newer initiatives or offerings? What are you guys doing in the present? What's going on right now?
Sure. As far as ideal client, so we raise capital for a lot of multifamily investments, and so we are fortunate enough to have many ideal clients right now, and a lot of those are North Carolina based. They don't have to be, but we love it when we can connect with people in person. And then, of course, twofold, we like working with newer investors because we feel like we can add a lot of value and help them diversify their investing. But then at the same time, we have some very sophisticated investors that we work with where we learn from them too. So it keeps it very interesting. And then, Clay, do you want to talk a little bit about our active offering currently? Aspen?
Sure. Yeah, absolutely. So, just to touch on the ideal investor really quick, I think my dad hit the nail on the head. Really, we can work with a broad range of investors and add value, whether you're new or sophisticated. And our business is built around doing due diligence on deals and doing due diligence on operators. And so while we always are pushing education and sort of showing investors and people in our network how best to do due diligence on these deals and on these operators, we also do a lot of that ourselves. And so I think there's someone that everyone can, assuming you're in a good place financially, you can benefit from Shining Rock Equity. Yeah, so our what we're currently working on, and we're always looking for deals and we're always looking for the next opportunity, but we're very selective. Like last year, I think we did 2 common equity deals and 1 private credit fund. And that private credit fund, we're going to be raising capital for that fund for a couple of years. And so that's what we're continuing to work on now and into the future. And so that's really, just to give a high level overview of that one. We wanted something that we could offer our investors that was a little bit more of a lower risk proposition and a little bit more of a hopefully steady return. And this is through a referral, and that sort of goes back to due diligence. We're very big on referrals. We want to work with people that other people have had great experiences with, and that's sort of how we start new sponsor introductions, is through referrals of other people. And so that's how we came into contact with the Aspen Fund. And these guys have a long 10-year plus track record of performing on their funds that they've offered to their investors. And so through that, that's sort of how we got comfortable with them initially, which then spurred more and more conversations with them. And we realized that they're not in the business to take big risks. They have a great reoccurring revenue business model that allows them to be super selective in what they pursue, and they don't have to go hit home runs. And sometimes if you try to hit a home run, you might not get anything. And so we felt like this was a great opportunity to jump into an investment that's going to be a little bit more cash flow focused, first of all, and best for someone who's a little bit more risk averse, or not even necessarily risk averse. I would consider myself personally, I'm younger, I'm willing to take some of those larger risks, but I have a nice allocation of my portfolio in this fund as well, because I like the fact that it can withstand market downturn. It can withstand some things going on in the economy and in the market. And I don't really have to worry. I mean, there's no guarantees, of course, but I don't really have to worry about this one, about, losing money in this kind of fund. And so that's what we wanted to offer our investors, and that's why we're excited about it.
What is a private credit fund? So it's easy to say I'm investing in real estate, right? For example, I have $25,000. I'm going to put in with other investors, buy a piece of property. I know what that is. If an investor were to invest with the Aspen Private Credit Fund, what is it and how does that work?
Absolutely. So in a nutshell, we provide our capital, ourselves and our investors provide our capital to the Aspen Private Credit Fund. And then from there, the fund managers of that fund will then go lend that money out to commercial real estate borrowers and multifamily, industrial, and retail mainly, with a large focus on multifamily. And so they'll lend this money out, $500K there, $1 million here, $1.5 million there. And then those commercial real estate borrowers pay interest on those loans. They also pay fees on those loans, origination fees. And those origination fees and the interest that they pay back to the fund essentially is what drives returns for ourselves and our investors. And so that's really at a high level what this fund is meant to do.
Oh, I see. Okay. Yeah, you have a lot of great stuff on your website. I need to talk to your marketing person, which I presume is a family member.
It is.
It is.
That's Sarah, my wife.
Oh.
she has her own graphic design company, so she definitely helps us out on that end.
Oh, well, I'll have to pick her ear because that looks really great. So in the future, we did past, present. Let's talk a little bit about the future. What sort of trends, either in your industry, for business, or investing, do you see coming down the pipe, like for 2025 and beyond, good or bad? What do you think is the future of your business?
Clay, you want to take that one?
Yeah, absolutely. So, I mean, there's a couple of things that come to mind, and we could talk market dynamics, and we could talk about the short-term oversupply that a lot of the multifamily or the multifamily markets are seeing in the Sunbelt markets particularly. And right now there is short-term oversupply in these markets that's leading to flat or even negative rent growth in some cases. I live in Austin, Texas, and right now rents are falling here just because so many developers came in and built. But these projects were started in 22 and 23. And since then, the market has changed dramatically. And so now you have developers who are not able to get projects started really since, the end of 23 and 24, they haven't been able to start new projects due to interest rates and a variety of other factors, including high construction costs. And so what you have now is we're absorbing an incredible amount of supply. Everybody talked about supply in 2024. And really one of the biggest stories was demand. Demand was the highest it's been in 20, 30 years in 2024. It was an incredible year for demand. And hopefully, it would be hard pressed to say that we'll see that continued demand for an extended period of time just because it was so incredible. But assuming we keep a good level of demand, supply is looking like it's going to drop off a cliff just because no projects have been started in the last couple of years. And so as we get into 26 and 27, if we can acquire property now and we get into 26 and 27, we should be able to benefit from increased rent growth in those years and potentially even longer than that. And so that's one trend that is really exciting for us. Being in the multifamily space, we see that writing on the wall with supply dropping off a cliff and hopefully the demand story staying strong. And then another thing too is, 2013 to 2021 and early 22 was the heyday of private market real estate investing. And people could jump in and pretty much, throw a dart and do really well. And those times have changed with higher interest rates. And so I think, and our business is built around this, but I think investors, retail investors, particularly people writing $25K to $1 million checks or $500K checks, I think these people are becoming much more educated because now they've gone through a little bit of a market cycle and are seeing some of their investments where they jumped in sort of all willy-nilly and are seeing those maybe not pan out as well as they hoped. And so I think that many investors are becoming much more educated on what they're investing into. And that's a big part of our business model. We want to provide education to others so that they can do their own due diligence while knowing that Shining Rock Equity is always evolving and always improving our due diligence processes so that when we speak or when we bring a deal to our investors, they know that they know the kind of due diligence that we've done on each sponsor and each opportunity. And we're always going to be evolving and improving that process. And so that's another trend, just the increased due diligence on operators and deals.
Mm-hmm. Those are great points, Clay. And, I think that bears out in the investments that we've brought to our investors so far. In addition to the Aspen Private Credit Fund, our other investments are doing very well, at least as well as expected, and some much more. For instance, we have 112 doors in upstate New York. It is already performing. It's a 10-year hold, but it's already performing as if it were year 8, and we're only 2 years in. We're returning a 10% distribution at this point, just for example. So we're really pleased with, because we've been very selective, it's bearing those kinds of fruit.
That's right.
Yeah. Fantastic. So a couple of follow-up questions. The sort of trend where you said rents are falling and supply is going down, is that very regional, or do you think that that's nationwide?
I would say absolutely that's regional. I mean, that's Sun Belt. So you're talking, sort of the Southeast, Texas, and some areas in the West. But the Midwest is performing still really well. It's sort of a slow and steady market. Developers didn't jump into that market and start building a ton just because it's not as sexy as Dallas, Texas, so to speak. And so you didn't see all the supply growth that some of these Sunbelt markets felt. And you're still seeing, 2 to 4% rent growth in a lot of those areas. And so that's a good thesis for the Midwest. And, we do consider that to be a decent market and worth our consideration. One thing that we like about our business is that because we are not operating in the day-to-day of these assets, we can look at the macro level trends going on and be able to allocate capital or offer opportunities to our investors that we think have tailwinds from the macro perspective.
Mm.
And so we can sort of jump around strategies. We don't have to specialize in one particular thing. Whereas when we're investing with an operator, we want them to specialize in one particular thing. We only want them to
100%.
do what they're best at, and we don't want them
Mhm.
jumping around to a bunch of different asset classes or geographies. Whereas because we're allocating capital more so, we can do it in a way that, you know, benefit or has the macro level tailwinds.
Hmm. Do you want to add to that, Rob?
No, he's 100% right, and that's why we have chosen. We've got a property in New York, we have a property in Ohio, one in Houston, and one in Dallas, and each one of those, the lead sponsors specialize in those areas in that asset class. So, to Clay's point, we follow the expertise of those lead sponsors.
You've also said too that you like working with new investors. So if I'm a brand new investor, technically I am, I don't invest. So if I come to you with my IRA account money, what's some really good questions that a well-educated client should ask you guys before coming on to invest with you?
That's a great question.
Yeah.
And I think, initially it goes with, what are the risks of this investment? And the only answer that you should hear from anybody is that you do risk your money in any kind of investment. It doesn't matter, our preferred or our private credit fund, we feel is extremely safe. But at the end of the day, there's always risk when you're investing. If you're investing in anything more than, treasury bills from the United States government, then there is risk in that investment. So that's the biggest thing. And that sort of goes back to the heydays of, call it 2013, 2015 to 2020, early 2022, is people were just sort of investing blindly, thinking that, the old adage, real estate always goes up. And while we have seen that to be true, it's only true over very long periods of time. In the short term, real estate does fluctuate. And so that's one thing that I would sort of harp on for a newer investor to ask is, what are the risks, and making sure that they understand those risks for any particular development. And then secondly, that's sort of a high level risk, but what are the risks with that particular investment? For instance, a development deal is inherently more risky than acquiring a core plus stable asset. And so what kind of opportunities do the group or the sponsor that you're speaking to, what do they pursue? Are they riskier? And are you being compensated for that risk through a higher return? Or is it sort of slow and steady and, you're not taking quite as much risk, but, maybe your return isn't quite as high as it would be on a development deal, for example. So I would make sure to understand the different levels of risk within the investment that you're making.
Good point. I would add to that too, particularly for new investors. You need to know, like, and trust the people that you are working with. And so I would advise folks to take the time to get to know the people you're investing with. Make sure your values align. You can tell a lot if you can spend 30 minutes to an hour on the phone or on a call or in a meeting. You can tell if you align. And so I would suggest they get to know the people that they invest with as well.
I love that. That's
Absolutely.
how we feel too. Yeah, at American IRA, it's a person first relationship. Sorry, Clay, go ahead.
No, you're totally right. And just to piggyback off of that, I was looking at a chart of the amount of meetings that it takes an institutional private equity group to feel comfortable investing with an emerging manager. So you're talking someone who's a little bit newer to the business, certainly, has potential, but these institutional funds were meeting with these emerging managers before investing with them an average of 5+ times. And so, that is a lot of meetings to go over sort of the business plan or the emerging manager's mindset and investment thesis. And so we want to bring that same approach not only to the operators and sponsors that we work with. I think generally speaking, we actually have many more than 5 meetings with them. But
True.
also we encourage our direct investors to, like my dad said, don't feel bashful or don't feel like you're taking up someone's time by asking for a meeting, even if it's just a chat and you have, you're going to take it slow and steady as you look at different investments. Don't feel like you're taking up unnecessary time. I mean, that's part of the process. That's what we do. That's what other people with similar firms do. They should be willing to speak to you and making sure that you're comfortable and knowledgeable about the investments that you're making. And so don't feel bad about asking for 2-3 meetings to get comfortable with somebody, if not more.
So where can listeners, if they're interested to contact you for more information, where can they find you?
So we are, you can go to our website, shiningrockequity.com, and find all of our information there.
Perfect. shiningrockequity.com. Fantastic.
Yes. And our email addresses are just our names. So it's rob@shiningrockequity.com and clay@shiningrockequity.com. And if you're listening to this and you know Kim, hers is kim@shiningrockequity.com.
Right.
There you go. Wonderful. Anything we didn't discuss that you want the listeners to know about yourselves or about Shining Rock or about Aspen Credit that we didn't get a chance to talk about?
Well, I will make one plug. I am a client of American IRA and have been super pleased with the service that Jasmine and her group have provided to me. So shout out to you, Jasmine. Thanks.
Oh, thanks so much. We appreciate that. We really do.
No, I second that for sure. We've had very happy investors who have worked through y'all. And so appreciate that. And then other than that, I don't have anything extra to add other than thank you for having us on.
Yeah, no, this has been lovely. I would love to have you guys on maybe later this summer. Again, just to chat and say hey, and maybe we'll have Kim if she's not camera shy. So that would be a lot of fun to bring you guys back. And we can continue the conversation. So thanks so much for joining us.
Sounds good. Thank you.
Sounds great, Jasmine. Thank you.
Now it's time for the IRA Cafe Q&A segment. This is where we answer a question from a client or a listener about your IRA concerns. And I'm actually taking the liberty to explain a little bit more about an EIN number or an employer identification number, EIN, kind of like a social security number, but for your IRA account. And so if your IRA account enters into investments that usually result in UBIT, unrelated, business income tax, UBIT. And if you enter into investments where that comes into play, your IRA account most likely needs an EIN number of its own. It is super, super easy to go to the IRS website and apply for an EIN number. Just takes about 10 or 15 minutes and it's free. You don't have to pay anything to the IRS at this time for the EIN number. We just sent out an e-blast, an email, a couple of days ago, and check your email if you're an American IRA client, and it has much more information about obtaining an EIN or for your IRA account. Now, we get a lot of questions, and I know that our client services team has had to answer a lot of questions about this. If you think that your IRA account needs an EIN or you're entering into an investment and you're being asked for an EIN for the investment, it is not the American IRA EIN. It is not New Vision Trust EIN. You need to get an EIN for your IRA account. So if you have any other questions, reach out to your CPA or a tax attorney and ask them if your investments for your IRA account require an EIN.
American IRA, LLC, a North Carolina LLC, acts as a third-party administrator for New Vision Trust Company, a state-chartered South Dakota trust company. As a neutral self-directed IRA administrator, American IRA does not recommend or endorse any investments, individuals, or entities, including financial representatives, promoters, or companies. American IRA and the IRA Cafe are not responsible for other statements, representations, or agreements, nor do we evaluate the quality or profitability of any investment. American IRA does not endorse guests on the IRA Cafe podcast. Guest opinions are their own and do not necessarily reflect the views of American IRA, its subsidiaries, associates, or custodian. Participation in the podcast is voluntary and no compensation is provided. American IRA is not a fiduciary and cannot offer financial advice. Please consult your CPA or another professional before making financial decisions.